There's a good chance you've heard the term before. Index funds. Maybe from a colleague, maybe from an article you skimmed, maybe from someone who mentioned it at dinner and you nodded along, but never quite looked it up. And here's the thing about that. Most people who've heard the term don't actually know what it means. Not really. They know it has something to do with investing. They know it's supposed to be the smart, simple option. They know Warren Buffett said something about it once. But if someone asked them to explain it in plain language, they couldn't. And that gap between hearing something and actually understanding it is costing people more than they realize, not because index funds are complicated, they're not, but because the financial industry has a long history of making simple things sound complex, so that you keep paying for the complexity. Today we change that. Let's talk about what index funds actually are and why they matter more than most people think. Let's start with something simple. When you invest in a single company, say you buy shares of Apple or Microsoft, you're making a bet that this specific company will grow, that its leadership will make good decisions, that its products will stay relevant, that nothing unexpected will derail it. Sometimes that bet pays off, sometimes it doesn't. And the honest truth is, even the most experienced investors in the world get it wrong more often than they get it right. Not occasionally, consistently. Study after study over the past 50 years has shown the same thing. The vast majority of professional fund managers, people whose entire career is picking stocks, fail to outperform the broader market over the long term. Not most of the time, almost all of the time. Let that sit for a moment. The professionals, with the research teams, with the Bloomberg terminals and the algorithms and the decades of experience, they lose to the market regularly. So what does that tell us about the rest of us, people with jobs and families and lives, trying to pick the right stocks in our spare time? It tells us the game is harder than it looks, and that there might be a smarter way to play it. That's where index funds come in. An index fund doesn't try to beat the market, it simply tries to be the market. Here's what that means in practice. Imagine you could own a tiny piece of every significant company in the United States or the world all at once. Not just Apple, not just Microsoft, not just Amazon, all of them. When one company struggles, another rises. When one sector contracts, another expands. The overall portfolio moves with the economy as a whole, not with the fate of any single company. That's essentially what an index fund does. It tracks an index, like the S&P 500, which represents the 500 largest publicly traded companies in the United States, and holds all of them in proportion to their size. You don't need to pick winners. You don't need to time the market. You don't need to follow quarterly earnings reports or analyze balance sheets. You simply own everything, and over time. Owning everything has proven to be one of the most reliable wealth-building strategies available to ordinary investors. Not the most exciting, not the most glamorous, not the kind of thing that makes for good conversation at a dinner party, but reliable. And at this stage of life, reliable is worth more than exciting. Let me put some numbers around this. The S&P 500, the index that tracks the 500 largest U.S. companies, has returned an average of roughly 10% per year over the past century. Not every year. Some years it rises dramatically, some years it falls, but averaged over decades, 10%. That means money invested in a fund that tracks the S&P 500 has historically doubled approximately every 7 years. Not because someone made brilliant decisions, because time and diversification did what they do when you get out of the way and let them work. Now compare that to the alternative, the average actively managed fund, where a professional is paid to pick stocks, charges higher fees, requires more monitoring, and statistically underperforms the index over long periods. You pay more, you get less, and you spend more mental energy worrying about it. Index funds flip that equation. Lower fees, broader diversification, less decision-making, historically better long-term results. It sounds almost too simple, and that simplicity is exactly why so many people distrust it. We've been conditioned to believe that complexity equals value, that if something costs more and requires more expertise, it must be better. In most areas of life, that's true. In investing over long periods of time, it often isn't. The most powerful investment strategy available to most people isn't the most sophisticated one, it's the most patient one. So if index funds are so effective, why doesn't everyone use them? It's a fair question, and the answer says more about human psychology than it does about finance. The first reason is boredom. Index funds are boring. There's no story to tell at dinner, no exciting bet to place, no moment of triumph when your stock picks pay off. You own everything, you wait, you don't look at it too often, you let time do the work. That's the strategy. And for a culture that rewards action, decisiveness, and excitement, patience is profoundly uncomfortable. We want to feel like we're doing something, like we're smarter than the average investor, like our research and our instincts give us an edge, and sometimes they do, in the short term. But short-term wins create a dangerous illusion. A few good stock picks convince us that we have a gift for this, that we can see what others can't, that our judgment is reliable, and then the market reminds us, quietly, expensively, that it isn't. The second reason is the financial industry itself. Index funds are not particularly profitable for the people who sell financial products. A fund that charges 0.03% in annual fees, which is typical for a basic index fund, generates almost no revenue for brokers, advisors, or fund managers. Compare that to an actively managed fund charging 1 or 2% annually. The difference in fees might sound small. It isn't. On a $200,000 portfolio over 30 years. The difference between paying 0.05% and 1.5% in annual fees can amount to hundreds of thousands of dollars. Not going to your retirement, going to someone else's income. This is why the industry doesn't shout about index funds from the rooftops. There's simply not enough money in it for them. The third reason is fear of missing out. When the market is rising, individual stocks seem to rise faster. Tech stocks double in a year. A specific sector explodes. Someone you know made a fortune on a single bet. And suddenly, the quiet, steady returns of an index fund feel inadequate, like you're leaving money on the table, like everyone else is getting rich while you sit patiently with your diversified portfolio. This feeling is one of the most dangerous forces in investing, because it causes people to abandon strategies that work in pursuit of strategies that feel better. And feeling better and performing better are rarely the same thing. Let me tell you what actually happens to most people who chase excitement in the market. They buy after a stock has already risen, near its peak. They sell after it falls, near its bottom. They repeat this cycle with different stocks over many years. They pay fees and taxes on every transaction, and they arrive at retirement with significantly less than they would have had if they had simply bought the index and waited. This isn't hypothetical, it's documented. Dalbar, a financial research firm, has tracked investor behavior for decades. Their findings are consistent and sobering. The average investor consistently underperforms the very funds they invest in. Because they make emotional decisions at the wrong moments, they sell when the market drops, they buy when the market rises, they confuse activity with progress. The index fund investor who does nothing during a market crash almost always outperforms the active investor who reacts, not because they're smarter, because they're more patient. And patience, in investing as in life, is one of the rarest and most valuable things a person can cultivate, especially at a stage of life when the temptation to make up for lost time can push even careful people toward decisions they'll later regret. The market doesn't reward urgency, it rewards consistency. And index funds, boring, simple, unglamorous index funds, are one of the most reliable vehicles for consistency that exists. Let's make this personal. Because everything we've talked about so far, the data, the fees, the psychology, means very little if it doesn't connect to your actual life. So let me ask you something directly. Where is your money right now? Not in theory, not where you intend for it to be. Where is it actually sitting? For a lot of people, more than would probably admit it, The honest answer is somewhere uncomfortable, in a savings account earning less than inflation, in a retirement plan they set up years ago and haven't looked at since, in a mix of investments chosen by someone else for reasons that were never fully explained, or simply nowhere. Because the whole thing felt too complicated to start, too risky to get wrong, too overwhelming to figure out with everything else going on. And so it waited, like so many other things. Here's what I want you to understand about that. The cost of waiting isn't just the returns you didn't earn, it's the compounding you didn't start. And compounding, real compounding over real time, is one of the most asymmetric forces in personal finance. Let me show you what I mean. Two people, same age, same income, same intention to invest. The first starts at 35, invests $400 a month into a broad index fund, does this consistently for 30 years, assumes an average annual return of 8%. By 65, they have approximately $600,000. The second waits until 45 to start, same $400 a month, same 8% return, but only 20 years instead of 30. By 65, they have approximately $235,000, same monthly investment, same return. 10 years of difference. The gap is not $48,000, which is what 10 years of $400 of monthly contributions would add up to. The gap is $365,000. That's the cost of waiting. That's what compounding does when you give it time, and that's what you lose when you don't. Now here's the part that matters most. If you're reading this and you're 45 or 50 or 55, this is not meant to make you feel behind. It's meant to make you feel the weight of now. Because the best time to start was 10 years ago, the second best time is today, not next month, not when the market settles, not when you have more clarity about which fund to choose. Today. Because 10 years from now, whether you start today or keep waiting, 10 years will have passed. The only question is whether compound interest will have been working for you during that time or not. Now let me address something practical. How do you actually access index funds? Without recommending specific products, because that's not what this channel does, the general landscape looks like this. Most major brokerage platforms offer index funds or ETFs, exchange-traded funds, that track broad market indices. The key things to look for are simple, low expense ratios, the annual fee charged by the fund. For index funds, this should be very low, a fraction of a percent. If you're being charged 1% or more annually on an index fund, look elsewhere. Broad diversification, a fund that tracks hundreds or thousands of companies rather than a narrow sector or theme. A reputable provider. There are several well-established names in this space that have been operating for decades with transparent, straightforward products. Beyond that, the strategy is simpler than most people expect. Invest consistently, reinvest dividends, don't react to short-term volatility, give it time. That's it. Not because simplicity is naive, but because in investing, simplicity, executed consistently over long periods, has historically beaten complexity, not always, not in every year, but over the kind of time horizons that matter for building real wealth. The evidence is clear, and the evidence has been clear for a long time. The question was never whether index funds work. The question is whether you'll give them enough time to work for you. If you've stayed with me this far, I want to pause for just a moment. Not to recap the numbers, not to summarize the research, just to acknowledge something. Most people who start a video about index funds leave before this point, not because the information isn't useful, but because useful information requires something from you. It requires you to look honestly at your current situation, to compare where you are with where you could be, to sit with the discomfort of that gap. And discomfort, even productive discomfort, is easier to avoid than to face. You stayed, and that tells me something about you. You're not here to feel informed without acting. You're not here to add this to the long list of things you mean to get around to. You're here because something in you is ready to take this seriously. And if that's true, if this is the kind of conversation you want more of, I want to invite you to subscribe to this channel. Not because the numbers matter more than the conversation, but because what we're building here takes time. One video gives you information, a library of honest conversations about investing, about money, about the life you're trying to build. That's something you can actually use. Each video on this channel is designed to stand on its own. You can watch them in any order. Come back to the ones that stay with you. Share the ones that say what you've been trying to explain to someone you care about. If that resonates, you know what to do. Now, let's talk about what this actually looks like in practice. Because understanding index funds intellectually and integrating them into your financial life are two different things, and the distance between them is where most people get stuck. Here's what I've observed about people who successfully make the shift from complexity to simplicity in their investing. It's rarely a dramatic overhaul. They don't liquidate everything overnight. They don't make sudden moves based on a video they watched. They start with clarity. They look honestly at what they currently have. They understand what they're paying in fees. They identify where their money is and whether it's actually working for them. And then they make one small deliberate decision, not 10, not a complete restructuring. 1. Maybe it's opening an account with a brokerage that offers low-cost index funds. Maybe it's increasing a contribution that hasn't changed in years. Maybe it's simply reading the statement they've been avoiding for 6 months. One thing, because one deliberate decision, made clearly, made today, is worth more than 10 perfect decisions made someday. Let me give you 3 questions to sit with after this video. The first, do you know what you're currently paying in investment fees? Not approximately. Actually, if you don't know, find out this week. The number might surprise you, and surprise, in this case, tends to motivate action. The second, is your current investment strategy something you chose deliberately or something that happened to you? There's a difference between a portfolio you designed with a clear purpose and one that accumulated over the years through default decisions and inherited recommendations. Knowing which one you have changes what you do next. The third, if you started investing $300 or $400 a month into a broad index fund today and did nothing else, where would that put you in 10 years? Run that number, not to make yourself feel behind, but to make the future feel real. Because abstract goals don't change behavior, specific numbers do. The gap between where you are and where you want to be is not closed by understanding, it's closed by decisions. Small ones, made consistently, over time. That's the bigger picture. Not the perfect fund, not the perfect moment, not the perfect amount. The consistent decision, made today. We started today with a gap, the gap between hearing a term and actually understanding it, between knowing something exists and knowing what it means for your life. And somewhere in this conversation, I hope that gap closed a little. Not completely, not in a way that answers every question, but enough. Enough to make index funds feel less like jargon and more like a tool, a simple, unglamorous, historically reliable tool that has helped ordinary people build extraordinary wealth, not by being clever, not by being lucky, not by knowing something others didn't, but by being patient. I want to say something about patience, because we talk about it as if it's passive, as if patience means doing nothing, waiting, hoping. But the kind of patience that builds wealth is different. It's active. It's the decision to keep contributing when the market falls and everyone around you is panicking. It's the decision to not check your portfolio every week. Because you understand that short-term noise is irrelevant to long-term outcomes. It's the decision to stay the course when a more exciting opportunity tempts you away from a strategy that's working. That kind of patience requires something. It requires conviction, and conviction requires understanding, which is why this conversation matters. Not because knowing about index funds will make you rich, but because understanding why they work makes it possible to stick with them long enough for them to work for you. Most people don't fail at investing because they chose the wrong fund. They fail because they couldn't stay the course. They sold when the market dropped. They chased returns when something else was rising. They second-guessed a sound strategy at exactly the wrong moment. Understanding removes the second-guessing. It replaces anxiety with clarity, and clarity, at every stage of building wealth, is worth more than any specific investment. Let me leave you with something to think about. Not a number, not a strategy, not a to-do list, just a question. What would your financial life look like if you stopped trying to be clever and started trying to be consistent? Not more sophisticated, not more active, not more informed about every market movement and quarterly earnings report, just consistent, the same amount, every month. Regardless of what the market is doing, regardless of what the news is saying, regardless of how you feel about it on any given Tuesday, just consistent, that question is worth sitting with. Because the answer, your honest, personal, specific answer, might be the most important financial insight you take away from this conversation, not what index funds are, but what consistency could actually build for you if you gave it the time it needs. If this conversation meant something to you, if something here shifted the way you think about investing, share it, not for the channel, for the person in your life who is still trying to find the right moment to start, the friend who keeps researching but never decides, the partner who feels overwhelmed by the complexity, the person you care about who deserves to hear that it doesn't have to be this hard. Send it to them. And if you have a question, something this raised that you want to explore further, leave it in the comments. Tell me what you want to understand better. Tell me what we should talk about next. This channel exists to make the complex feel clear, the overwhelming feel manageable, the distant feel possible. That's the bigger picture. Not just what to invest in, but why it matters, how it connects to the life you're building, and what becomes possible when you finally stop waiting and start. This is the bigger picture, and the best financial decision you'll ever make isn't the smartest one. It's the one you actually make.